When you go to sell your house, one of the first things you do is you look at the Zillow appraisal and you say, well, Zillow says my house is worth $400,000 and therefore I'm going to list it at $400,000. Well, by listing it at $400,000, I've now increased the probability of a transaction occurring at that $400,000, which now becomes self-referential and actually feeds back into the algorithm. Once I've sold my position, I am no longer a voter in the market, right? This is Warren Buffett's voting machine versus weighing machine. And so all I have is basically an exit voice. I can choose to sell, but once I've sold my position, I'm no longer an active participant in the debate about whether this is a valuable stock or a not valuable stock, unless I'm willing to buy back in.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
For our listeners, Mike, give everyone really quick what you've done throughout your career, some of the key highlights, and maybe some of the experiences that led you into looking into the work that you've done around passive investing and how it's changed market structure over the years.
Okay, so I've been doing this for about 30 years. Graduated like many people in the industry from, finance program. I went to the Wharton School of Business for my undergraduate, got a degree in finance and information science, what was actually called operations research at the time. That exposed me to both finance and to the idea of mechanical systems and how to think about how systems operate within a framework for which they've been programmed. If you design a factory in a particular way, it's going to behave in a certain way. If you design a market in a certain way, it's going to behave in a certain way. Like most, I tossed all of that learning to the side for a very long period of time as I focused on the traditional ideas of what you're supposed to do within active management, which is try to define value, whether in an absolute sense or in a relative sense. And fortunately, that stood me in pretty good stead through most of my career. If it had not been for kind of those insights, I wouldn't have sidestepped what became the dot-com cycle. I managed to, find an area in which I was able to contribute good performance for an extended period of time in small cap value. And then in the aftermath of kind of the rally in small cap value that went from 2000 to 2006, when the broad market fell and small cap value did extraordinarily well, I began to recognize that I was seeing distortions happening in small caps because of the influence of things like equity long short. The relative pairs trading had gotten to the point that people were paying far too much for low quality stuff on the idea that it was distinctly undervalued. Used some of those insights to start a transition in my investment style that coincided with my moving to a hedge fund called Canyon Partners, where I became more traditionally macro in construct, which meant I was looking much more at what was happening in the global macroeconomic environment and what mispricings were being created in various areas. Was fortunate enough to identify the housing bubble, or more accurately, the mortgage financing bubble that existed around 2006. And managed to navigate a reasonable outcome, for the next couple of years. And the opportunity that emerged post 2008, when stocks were deeply undervalued, when credit was deeply mispriced, really powered my career through the period of about 2016. In 2016, I had, what I recommend for everybody, an opportunity to basically step away for a period. I took a brief sabbatical after closing my hedge fund in early 2016. And at the same time, an academic or a white paper came out by a partner at AQR called, his name's Lasse Peterson. He wrote a paper called Sharpening the Arithmetic of Active Management that really pushed back on the concepts of how we termed or how we highlighted the difference between active and passive management. Passive had always been kind of thought of as just there, right? That it didn't actively participate in markets. It was by definition passive, and therefore there was very little reason to believe it was having any meaningful impact on market structure or market performance. Lasse highlighted a really interesting footnote to the formative literature, a 1991 paper by Bill Sharp called The Arithmetic of Active Management, hence the title of Lasse's paper, Sharpening the Arithmetic of Active Management. That's the source of the insight that you'll hear everywhere that, well, passive is just active in aggregate, right? And so the only difference between the two should be the fees charged to manage assets passively, since the passive market or market in its totality is simply all the active managers combined. Lasse made a very interesting insight, which is footnote number 4 in that paper in 1991, which gives you some idea how deep into the weeds you have to start digging before you can develop real insights in this space. Highlighted the definition of passive management as somebody who never transacts, and active as anyone who is not passive. Lasse's insight was that on index reconstitution, what we call rebalancing, that required passive managers to trade, and as a result, they became active managers for a brief period of time. Now, importantly, this paper and the insight behind it actually is what explains the development of the hedge fund world post-2016, in which the largest business is largely around index arbitrage, whether that's the basis trades in treasuries or whether that is arbitraging the differences in price that are created when you go to buy an ETF versus the components that exist in the futures themselves, or even more powerful index inclusion arbitrage, which is basically speculating on companies that are going to be added into the S&P 500 or into a total market index, tends to be focused around the S&P, and the opportunities that created for active management, right? So hugely impactful paper, not just for me, but in many ways to industry development. My contribution to it was to recognize something else, which is that passive strategies, by virtue of investor flows, are forced to transact every single day. So you have your paycheck come in, that flows into a Vanguard total market index. By definition, they are transacting, and the numbers are really staggering. At this point, Vanguard alone is receiving somewhere around $1.5 billion per day. That's a good-sized hedge fund that has to be deployed every single day. And once you recognize that, then it becomes a very different question. Instead of saying, is there an impact? You start saying there has to be an impact, because this is not actually passive. Instead, it is a systematic algorithmic strategy that simply boils down to, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And so my work basically proceeded from that point. And now 9 years later, we're at a point where both my work has progressed significantly and the academic literature is starting to catch up. Most importantly, in 2020, a paper came out called the Inelastic Market Hypothesis, by Xavier Gabay and Ralph Koyajian at Harvard and Chicago, respectively, that really began to hit on some of the narrative that had existed about passive investing to that point. Most importantly, highlighting that markets that we had presumed were highly elastic, in other words, capable of adjusting to large changes in supply and demand with relatively small changes in price. It turns out that markets are the exact opposite. They're actually highly inelastic, meaning small changes in supply and demand can lead to very large changes in price. And as that academic literature has progressed, it's both provided additional fuel for my arguments as well as avenues for exploration that I'm sure we'll discover as we go further through this interview.
I think it remind me to come back to Coinbase. When you talk about index inclusion, I think that's a relevant one this week to talk about. But inelasticity, I think I just want to maybe break that down a little bit and
Sure.
help people understand what that is. Our listeners on average on this show are not institutional investors. So I find the most effective thing sometimes is to break it down into terms of real estate. It seems to, be the most relatable for people. So correct me if I'm wrong on what you're saying about inelasticity, is basically if you have a row of townhouses and they're all basically the same and they all start out, they're worth, $300,000 and one sells for $305,000. Everyone sort of expects that, okay, maybe that house sold for a little bit more. There was some reason, all the houses are kind of worth 300,000. They might be worth 305, but there's some price discovery that might happen. But if all of a sudden one sells for 305, one sells for 310, one sells for 315, there starts to be this point where everyone revalues their house and everyone starts to say, hey, there's going to be this high demand. The prices are driving up, and it's because that same supply, you would expect there to be all these houses, but there's kind of a limited supply. Even though there's tons of houses in the city, there might not be that many for sale. And so it distorts the price discovery because there's not enough transactions sort of happening through the lack of availability. Is that?
Yeah, so I think that's an interesting analogy. What I would highlight is let's imagine that row of townhouses, right? There are two at the ends, right? So they have distinct characteristics. They likely have more windows. They likely have more light. We can establish that as a pricing metric, right? And then everything in between is basically infill. They're all functionally the same. They may have different staging components to them. Somebody might have renovated and introduced more modern components, et cetera. That has to be considered in your pricing analysis, but real estate actually offers maybe even a better example of what you're highlighting, which is the introduction of things like Zillow, right? Which are large databases that key off of where transactions have occurred. And those databases have increasingly become self-referential. When you go to sell your house, one of the first things you do is you look at the Zillow appraisal and you say, well, Zillow says my house is worth $400,000. And therefore, I'm going to list it at $400,000. Well, by listing it at $400,000, I've now increased the probability of a transaction occurring at that $400,000, which now becomes self-referential and actually feeds back into the algorithm, right? Passive investing works very similarly. Whatever the last transaction price was is presumed to be the right price. And so when new flows come in, they actually reinforce that price. They reinforce that behavior. And because they are flows and the markets exhibit frictionality around that by the process of buying actually causes prices to change. If I'm buying, prices should shift up slightly. If I'm selling, prices should shift down slightly. I'm actually creating a feedback loop that reinforces momentum components. And that's really the key insight that comes in. Now, there are other issues associated with passive that drive further distinguishing features that we could look for, among those being the sheer quantity of money that is put to work. For example, in the largest stocks, it turns out that their liquidity doesn't necessarily scale with market capitalization. And so one of the really surprising things that comes out of a deep analysis of the impact of passive is that it's oftentimes the largest stocks that are the most affected by these flows.
Yeah. So let's break that down a little bit more. Like why is that, covering, let's talk about maybe how are some of these index constructed? And what makes them momentum driven in nature?
So, well, there's a couple of components there. So first, let's hit the momentum component. That's simply the feedback loop that we've identified already, right? That if a price goes up and it increases the weight of the stock in the index, the next dollar that comes into the index is going to try to buy more of the security that has risen in price. So you can immediately see how that creates a feedback loop that occurs. Now, that is exacerbated by this dynamic of inelasticity. And rather than simply talk to it, let me actually just share, maybe I can share my screen to show a slide that highlights this dynamic.
To clarify for listeners too, this momentum idea is often terms viewed by the public when you see something that's called market cap weighted. When you see an index that's market cap weighted.
Anytime you have a market cap weighted index, by definition, it's going to exhibit this type of dynamic where the next dollar in is going to buy more of the stuff that has risen in price, hence market cap is higher, right? It'll buy more of it and less of stuff that hasn't. The chart that I just put up on my screen is drawn from one of those academic papers that I referenced. This is Valentin Haddad's work. He's at UCLA. And what he's looking at here is the elasticity. So 1 would be a perfectly elastic stock. 0 would be a perfectly inelastic stock. And what we're seeing here is both in red, this is the theoretical relationship that should exist. This is because of the dynamic that I mentioned before, that liquidity does not necessarily scale with market capitalization. It actually scales with volume and volatility. Just to put parameters on that, NVIDIA is roughly 300 times the size of the smallest stock in the S&P 500, but it trades somewhere around 10 times as much in volume. The volatility, which can be proxied by things like the bid-ask spread, is also going to be lower in the largest stocks. And as a result, there will be less market-making investment in those because the profitability is just not there, right? That spread between bid-ask and the volume is what determines the potential profitability for a market maker. And so they'll put less capital than you might otherwise think against these largest stocks. That contributes to this red line that we're talking about. The largest stocks should be less elastic. The smallest stocks should be slightly more elastic. But notice the green, which is actually the empirical data, shows something quite different, which is a more extreme inelasticity. And this is because of a secondary impact, which I call substitution or substitutability. If I'm building an index, right? So let's say I'm building a total market index. Do I care about the smallest stocks in the index? Do I have to include them? No, I really don't, because they're 0.0001% of the index. And so they don't really meaningfully impact the price performance of the index. As a result, I'm not in a rush to replicate those positions. That means that the stocks are much more elastic and less affected by these dynamics that we're referring to. There's a second component that I'll come back to in a second that also helps explain this. But the largest stocks, look how inelastic they are. And this can almost be thought of as a multiplier. So 1 divided by the elasticity is going to be pretty close to the multiplier effect that a single dollar in creates. And so a single dollar into the largest stocks can have multipliers that are approaching 100x. So $1 in creates $100 of market cap. At the smallest stocks, we see numbers that are approaching 1, right? So 1 over 0.75 is basically telling you that you're going to see somewhere in the neighborhood of a 1.5 times multiplier, really a 1.33 times multiplier. That suggests that a dollar into a small stock barely adds $1 of market cap. That in and of itself, I just want to orient people to this. The efficient market hypothesis assumes that a dollar in, because every buyer has to have a seller, it assumes that a dollar in creates 1 penny of market cap, right? So even at the smallest stocks, we see that the efficient market hypothesis is misspecified by about 130 to 1. That's not even good enough for government work. But if we go to the largest stocks, suddenly we're talking multipliers in the neighborhood of 100 times. Right? That means that the absolute largest stocks are so inefficient relative to what the efficient market hypothesis would conjecture that it's not even the same planet, right? Like we are actively engaged in behaviors that are systematically biasing the market as long as passive has inflows towards outperformance of the largest stocks. And this is why we've seen things like the value factor or the small factor that historically have offered excess returns basically turn into death traps for investors.
So when we talk about flows having a multiplier effect on market cap, like going back to real estate and trying to put that in real estate terms, he's like going back to the houses where you have, somebody comes in and buys a house for 305 instead of 300. So now all 10 neighbors down the block think their house is worth $5,000 more. Well, only $5,000 extra came into the market. But now as a market cap, if you add up the value of all those homes in the neighborhood, it looks like there's an extra $50,000 worth of real estate value in the neighborhood. And if the next guy comes in and buys it at 310, this same sort of thing happens. Right. It gets bigger and bigger and bigger. And so, but if all of a sudden, one person comes in and says, well, I got to fire sale my house because I'm getting divorced or whatever. And the only willing and able buyer I can find right now is 300,000. They sell their house for 300,000. All those other homes that had banked on that flow coming in and pushing up their equity on paper, right? It just kind of snaps back to that fundamental $300,000 value you started with 2 weeks ago. And, the market cap is then erased. So it got distorted on the way up, but it gets sort of distorted, if you will, like, I don't know,
It
like
can be
easy come, easy
distorted.
go on the market cap,
Yeah, it can be distorted in both directions. I would highlight that the example you gave, where there's a seller who's under distress,
Yeah.
the odds are actually pretty high that they're going to take a much more meaningful discount than the person who simply wanted to sell their house for more, right? If that person simply wanted to sell their house for more, they had to find a willing buyer. If you're forced into distress, right, suddenly you are actually very dependent upon buyers, looking at it and saying, from a fundamental value standpoint, am I being compensated for taking the risk of this transaction when I may not want to have to do this transaction? And so prices tend to fall more rapidly than they can rise. This, of course, is the story of the global financial crisis, where home prices were forced into distressed sales by banks that took ownership of those homes. They didn't really have what are called loss mitigation procedures for how to handle that influx of real estate, and instead they just chose to dump it. That caused real estate values to fall, which meant that people that needed to refinance or were forced to try to sell for more traditional reasons were suddenly confronted with prices that had been hammered, potentially leaving them underwater on their loans. And that then, of course, contributes to the sort of financial distress that we experienced during the financial crisis, where otherwise good borrowers were suddenly saying, wait, why would I hold on to this property? I'm so deeply underwater, I'm just going to get rid of it as well. So selling activity actually picked up. Something very similar could happen in the stock market, right? If we were to see a reversal of flows, or if the next marginal player is selling under distress, well, part of the great irony is that passive would assume that is the right price, right? It requires the fundamental analysis that you were highlighting to step in and say, no, I think there's actually an opportunity here. That doesn't exist in the passive world. It simply is a function of, did you give me cash? If so, then buy. If you ask for cash, then sell, right? Nowhere in that is an analysis of what is the fundamental value of that house or that stock. And so it exacerbates behavior in both directions. And unfortunately, that is indeed what we are seeing in markets.
So to be clear here, the traditional active manager of investments should, in most basic terms, look at an investment and say, this has good value, should produce a good return over time. And if the market goes up, they should reevaluate their investment and say, I've had a great return. I've gotten it faster than expected. This is now overvalued. So I'm going to sell and look for a different good deal, right? You take that out of the market with passive investing, and you end up with, like you're saying, I got paid, buy. But that is not really the problem, right? Like in the financial planning world, systematizing savings isn't a problem, doesn't create an issue. The problem that you're identifying is where that money's going to on a weekly or biweekly basis for people, and it's going through the passive funds. And there's not a mechanism of control that's causing price discovery in the markets. It's just, we're buying this basket of 500 stocks, and everyone's sort of investing in the same momentum trade at this point.
Yes, that's correct. Although the more likely outcome is actually something that has existed in markets for a very long period of time. Once I've sold my position, I am no longer a voter in the market, right? This is Warren Buffett's voting machine versus weighing machine.
Mm-hmm.
And so all I have is basically an exit voice. I can choose to sell, but once I've sold my position, I'm no longer an active participant in the debate about whether this is a valuable stock or a not valuable stock, unless I'm willing to buy back in, right?
Mm-hmm.
And so if the active manager exits, and it turns out that it's not a fundamental valuation that we're concerned about, instead it's a flow-driven settling of supply and demand, with passive being the dominant flow and simply saying, whatever the price, I'll buy given cash, right? That means the active manager gets less and less and less voice in the market. In other words, shouting that stocks are overvalued when you're not fully invested in them, you don't actually have a voice, right? It's like shouting that the emperor has no clothes at a nude beach. Nobody cares.
Okay. Uh, God, this conversation gets so wild in my head so fast.
Yeah, it is one of those things that requires you, unfortunately, to step out and really think about what's happening with transactions. But this, unfortunately, is what we are seeing, right? The value managers have tried to force themselves into what I would argue are broadly lower and lower quality stocks and smaller stocks that tend to be less impacted by this passive bid. But perversely, in many ways, what they're actually doing is trading down in quality, which means they are then even more exposed to idiosyncratic volatility in their outsized position in these lower quality names. A really simple example would be the continual inflation of values, regardless of market capitalization. I'll actually share another slide on this. Give me one second. On the left-hand side, we're looking at a theoretical evaluation of what should be happening to valuations as passive gain share. So the traditional market dominated by active managers exhibits mean reverting characteristics. As stocks get too rich, you choose to exit. That creates selling pressure, which causes stocks to retreat.
Mm-hmm.
In a passive manager framework where passive managers are gaining share because they simply say, did you give me cash? If so, then buy. They actually create what's called a mean expansionary framework. And so valuations rise over time. But importantly, the distortions get larger and larger by market capitalization, which leads to the chart on the right, which shows median valuations rising in a nearly continuous fashion. But for the largest stocks, that becomes extremely amplified. And so this is perversely, what ends up happening is you end up deciding this is really cheap and this is really expensive. And the answer is they're both really expensive. But ironically, this company often will have debt. And so what we're experiencing is asset values rising. That creates the false perception that there's equity value because the total asset value has risen, right? And the debt remains fixed. Therefore, you're convinced that there's significant intrinsic value to the equity claims. But if the overvaluation is actually a byproduct of this component, ironically, it could mean that you don't actually have an increase in asset value. You've taken on additional debt because the market allows you to do so. It sees the collateral of your equity value, and it dramatically raises the risks of absolute loss, where you truly get wiped out by an underlying credit position in the capital structure. This is unfortunately what happened in the early 1930s with the Great Depression, where equity values had been inflated because of a total asset increase. Using that equity value as collateral, companies then took out debt. And when things normalized, quote unquote, right, or became extreme to the downside, they suddenly found that they could no longer obtain capital and were forced into bankruptcy. And so this is one of the reasons why my work, while it is favorable to the interpretation that value has been disadvantaged and therefore value managers might have opportunity going forward, the manner in which they choose to behave as we go through this process actually paradoxically raises the risk of having an overweight towards junkier or lower quality companies. And unfortunately, we see this across value portfolios.
So I hadn't even thought of that. I hadn't even considered that downgrade in value. And so basically you're saying, the equity is there when you check your brokerage statement, right? And the company equity looks okay. And so people are buying it and it looks okay. But if the flows stop in the market and you have the more historical mean reversion, because the company was rising in equity, the credit markets were more willing to expand their debt and credit issuance to the company. And so when the mean reversion happens, it's easier to fall below the bondholders essentially need to get repaid in the capital structure if a company goes under than,
yes,
before you get paid on equity.
That's the right way to think about it. And unfortunately, we have examples of this, right? So for example, the inflation of asset values associated with telecommunications companies, in particular, internet service providers and fiber layers in the early stages of the dot-com, many credit investors tried to participate in the dot-com era by chasing the higher yields that were offered by these companies believing that they were underwritten by the significant equity values.
Mm-hmm.
When the equity values collapsed, the bond prices collapsed because the companies actually didn't have an intrinsic value that was above the bond floor. And so they went bankrupt and the recoveries were terrible,
So,
right? Something very similar seems to be happening this time around as well.
so how does that affect the credit markets? Because okay, like we've talked so far about, hey, I mean, basically for anyone that hasn't caught on yet, hey, it's super hard to pick stocks because everyone's investing in the same thing. Broadly speaking, it's a big momentum trade, pushes up and it becomes hard to beat. If anyone listened to the Jim Bianco episode a couple weeks back when he talked about indexation, inclusion, and pressing the Mag 7, it's the same idea. But how does this affect the credit markets? Like, because in all the tariff mania that happened this last couple months, credit spreads widened a little bit, but it was relatively tame relative to what happened in equities. Like credit spreads were historically very tight and they're still pretty, not as tight, but they definitely didn't blow what I would say is blow out. Right. But there's
this is unfortunately the key risk. It's actually exactly the topic of the Substack that I was working on when you and I chatted. Let me actually share a different slide. This is actually looking at credit spreads versus kind of my target model, right? Mm-hmm. And in red is actual credit spreads. In black is my model of where credit spreads should be. You can see credit spreads blew out wider than fundamental in the distress around the GFC. Yeah. They also blew out wider around events like Enron and WorldCom, which would be good examples of that, where we discovered that there was significant fraud, right? Now, if you have a model for credit spreads that is able to capture fraud, you've overspecified your credit model. And so I actually point out that this is really important that we didn't pick that up at all. And as a result, that was a legitimate opportunity where credit spreads were too wide. On the flip side of that equation, though, is what was happening prior to the GFC. This is in part because credit spreads are negatively correlated to both equity values and to interest rates. So low interest rates tend to lead to wider credit spreads. Higher interest rates, perversely, because people look at the total return available to them within the credit, tend to understate the actual credit risk, right? You can basically norm across your portfolio and say, yeah, it's an adequate return in total. I'm going to ignore some of the individual credit exposures. And that is what happened prior to the GFC. You can see this widening that occurred effectively as the higher rates themselves became a risk factor for companies that needed to refinance, while the market failed to, incorporate that. We saw that same phenomenon in the past 2 years, right? Now, the past 3 years, this has been a function of the significant widening of credit spreads. Increase in interest rates that mean that many high yield companies can't issue paper. They simply can't refinance themselves at this much higher level of interest rates, or they would face financial distress. As a result, there's been very, very little issuance, and perversely, as passive strategies buy credit and do it in the same manner that they do with equities, that shortage of supply basically means that the remaining credit gets bid up relative to its fundamentals. And so that same type of divergence has emerged here. The blue line, which everyone is wondering why I haven't talked about, this is the actual bankruptcies that are being observed. And so importantly, we're actually seeing bankruptcies hit near record levels. For large companies exceeding $50 million in assets, they're now approaching or exceeding the levels that we experienced during the global financial crisis. And yet, perversely, credit is safe, right? Why? Because equity value is perceived as a metric of jump to default, right? How far does this have to fall? How far is this away from that problem? Those inflated valuations give creditors comfort, where, in my opinion, they shouldn't be drawing it.
So it'd be similar to the guy willing to write a mortgage right now saying, well, I'm only borrowing, 70% loan to value. So I'm really secure in this position. When in reality, if a couple sales from now, in real estate, obviously doesn't move this fast, but if a couple sales from now, the home goes down 40% in value, you thought you had this big margin of error in your loan to value, but now it's gone, and it's gone quick.
Yeah, that's exactly right. And unfortunately, the more typical is somebody stretching to buy without the financial sophistication to do the sort of analysis that you were highlighting. And so they're putting 5% or 10% down. They're trying to buy a starter home with a subsidized interest rate from a new home builder, hoping that in 2 years they'll be able to refinance at a lower level of interest rates. Because the Fed has been so slow to cut interest rates despite meaningful deterioration in elements of the economy, we're actually now starting to see that play through. More and more homeowners are finding themselves trapped in homes that are underwater, and without interest rates falling, they can't refinance, and therefore their teaser rates, just as we saw in the lead into the global financial crisis, are now threatening to reset. If you bought a new home from a home builder with subsidized interest rate 2 years ago, suddenly you're running the risk that that interest rate could rise 300 basis points as you look at your next payment. That suddenly takes that very affordable home, turns it unaffordable, and creates the conditions under which you might become a distressed seller and affect prices in the manner we were talking about earlier.
So the same thing translates over to securities in the market with passive flows, where you've had the economy's been good. People have been told over and over again, put money in your 401k, take the match. And the 401ks have a default option, that puts them in some either index fund or what I call closet index funds, right? It's not the S&P 500. It's just like the S&P 395, right? It's with a correlation of nearly 1. But they're doing that. It's driving up the prices and the values in the market. It's self-reinforcing, and for lack of a better term, the music's playing, and everyone's dancing. And the same situation where the home value goes down because they become a distressed seller and they have to sell, and they're underwater. The flows are what is driving the market higher. But if the flows stop because people lose their jobs, companies pull back on profit sharing or pause company matches, whatever it might be, the flows changing is what would suck the air out of the market, so to speak, and cause the, I don't want to say real intrinsic value to be discovered, but it would cause price volatility to, I would imagine, some extreme levels.
Yes. I mean, the simple answer is absolutely that can be a component. And I would argue that's a big chunk of what's happened to the active manager community, right? They increase those who have been trained in traditional process of things like discounted cash flow analysis, in which they're trying to project forward profitability or the forward cash flows associated with the company. They do the analysis and they're like, this is absurd. This makes no sense. I can't possibly buy these stocks. Well, if they're not the marginal flow of capital, in fact, if they are experiencing outflows, and so actually I'll show a chart that I was not going to show. John's analysis was not actually tied to a particular level. He was relying on theoretical arguments when he made that. But the really critical thing to understand is that since about 2014, active managers have been receiving outflows, meaning they are net sold in their positions, while passive has taken that place and become the net buyer of almost everything. In other words, more than 100% of the net flows now coming into the market are passive in their construction. Fundamental trading, where people are actually trying to reference an actual underlying characteristic, whether it's cash flows, book value, earnings, dividends, has declined to less than 10% of transaction activity as of 2017. We think it's even slightly below that today. If you exit your position, if you sell, you're no longer an active participant, right? You're basically sitting on the sidelines. And the only vote that exists to you at that point is either to deploy cash and buy stocks that you think are overvalued, or to hand the cash back to your investors. And again, that's really what we're seeing, some of it by choice and most of it forced. So those voices of reason are actually getting kicked out of the market, is the easiest way to think about kind of what is playing at this point. That leads to the conclusion, as you correctly put it, that everything's fine, right? There's that internet meme, right? This is fine as the house is burning down around you.
Yeah.
That unfortunately is the conclusion that I draw from, what people try to say when they say, well, what's priced into the market, right? The answer is nothing. It no longer, is driven primarily by fundamental insights. It's primarily driven by a very simple factor. Do the vast majority of Americans still have the jobs that they had the week before so that they can contribute flows to the stock market? And as long as that continues to be the case, as long as we don't see a substantive change in the direction of those flows, either tied to things like the retirement of baby boomers or significant job loss or changes in regulatory policy around allocations, one of those we're starting to see as more and more 401ks consider adding private assets. That becomes dilutive to the flows into the public markets and threatens that balance that we have seen so far. So all of these things are non-fundamental in their underlying construction to the individual company, but can have a very material impact on the trajectory of prices at some point in the future.
So what about institutions or like foreign sovereign wealth funds, or, like in the last couple of weeks, you've heard a lot of stuff about, Europeans pulling their capital home, whatever it might be. Like those aren't, Americans with 401ks. So they're transacting. What effect is that having on the markets?
Well, the inflation of valuations in the United States is a byproduct of the passive revolution having gone further here than most other places. Yes, many of the companies are excellent. Yes, we have some of the most innovative companies out there. But I'd highlight that this, valuation levitation that has occurred has affected companies that are both innovative, like an NVIDIA, and companies that broadly can be described as harvesting, right? A company like Apple, which hasn't had a significant innovation in probably 10 years. I think the last significant one was replacing the headphone socket on an iPhone. We get thinner phones, we get wider phones, we get, slightly higher resolution, but at the end of the day, it's functionally unchanged for over a decade in an area that we think of as the highest technology. Those companies are benefiting from this as well. And candidly, they should have seen their multiples compress as they've failed to deliver significant earnings advances. And we've actually seen the exact opposite, right? Their valuations have increased. Perversely, this then helps explain some of the societal ills that we're experiencing, where people feel that their good activities and their productive contributions are not being recognized unless they happen to be a mid-level marketing person at NVIDIA or Apple, where they're seeing significant benefit associated with their stock price appreciation for their stock options. The simple reality is the people that are working at Apple are not that much better than the people that are working at other companies across our society. It's just that has a unique benefit associated with the manner in which we invest today. And that can in turn create tremendous fortunes for people who honestly are not adding incremental productivity. But that's not how they think of themselves, right? They think of themselves as innately gifted and genius-like in their construction because they're winning at the game of life. That causes them to be dismissive of the concerns of people who aren't benefiting in the same way. And it helps to explain a lot of the right-left divide that we're increasingly seeing, which is not really right-left. It's elite versus non-elite. And that elite increasingly just means, did you work for NVIDIA? Did you work for Apple? Did you work for Microsoft?
Does that become a really big advantage for those companies? Like when you have structural, systematic flows to your stock price because of index inclusion and having a significant weighting in major indexes, that you can say, hey, we don't offer a $300,000 salary. We offer a $75,000 salary, but we also give you, stock options. And those stock options should be like really lucrative. They always have been now for years and years. And, and so like when you factor that in, we actually pay really, really well, but the company doesn't necessarily have to, like, that's a salary being funded by a owner of the stock, right? The investor, as they bring more flows to the company, which is not any different than a small family business that has to pay for an employee out of their pocket as the, owners of the company. I think that the difference there is like, is it an outsized benefit because of a structural flow from people that don't really understand that their decision to just invest in passively in an S&P 500 index fund or something is structurally reinforcing a large company's ability to have a significant advantage. And then if that's true, does that significant advantage in of itself then become a tangible value add advantage for the company that allows it to compete better and be a better company?
Yeah, I mean, a perfect example of that would be how we treat stock-based compensation, right? So, back in the late 90s, early 2000s, there was a ton of debate about whether it was appropriate to expense stock options, whether we should be treating that as an expense to shareholders. That language has largely been lost because, again, nobody really cares about the fundamentals. They simply care, is the price going up? And so we've constructed a narrative that says, well, people are more productive if we give them stock options. And therefore, this is a good thing. We should largely ignore it from our analysis, in part because if we don't ignore it, our conclusion is these stocks are horrendously overvalued. And as a result, we can't invest in them. Well, congratulations. You are no longer an active participant. You no longer get a voice, right? So we're forced to change our narrative to conform to the reality that we live in. And unquestionably, this is creating a tremendous structural advantage. You have a choice. You can go out and start your own small family business, or you can go to work for NVIDIA. One offers you $300,000 of cash compensation. The other one offers you a $100,000 base and $200,000 worth of stock options, or maybe even $100,000 worth of stock options. But because of our mental framing, we associate NVIDIA with going up, and therefore we're going to make a ton of money on our stock options. I'm willing to go to work for NVIDIA, despite the fact that they're offering me lower compensation. Perversely, that means that NVIDIA then overstates its profitability, right? There's a fantastic piece that was written in the aftermath of the dot-com by Michael Jensen, who was instrumental in many of the theories of shareholder value in the late 1960s, and is actually the person to whom we owe a debt of gratitude, and things like the SSRN public databases of white papers that are like a GitHub for theoretical papers. His paper was called The Agency Costs of Overvalued Equity. And what he highlighted was that it was actually even more damaging for a company to have an overvalued stock price than to have an undervalued stock price. Because an overvalued stock price offered false signals of the efficiency and effectiveness of management actions that then caused them to make bad choices, right? And I would argue that, many of the expense paddings and tax arbitrage features, et cetera, of very large companies exhibit that type of reinforcement, right? What we're doing is good because our stock price is going up. It's reflected in the stock market. Not, are we effectively managing ourselves? Are we compensating our employees in a manner that is durable and sustainable so that they can afford to live in the communities in which they work? Well, if the only way they can do that is through a Ponzi finance scheme in which their stock price appreciation allows them to generate higher incomes, then that's not really actually a sustainable business model.
At a certain point, do you think that the companies just they got the momentum going and now they have the passive flows, and so you largely just have to exist? You don't really have to innovate the same way or provide the value. You can just kind of, if you have some kind of monopoly or whatever, clinch onto it.
Yeah. I mean, if anything, it actually suggests to do the opposite of what you would expect to do, right? The less disruption you cause, the less likely you are to cause the few remaining active managers to quote unquote dump your stock. And as a result, like doing nothing becomes almost the default, right? Why take the risk? Why do something like what Mark Zuckerberg did with Facebook, renaming it Meta and trying to refocus the company on virtual reality, which was obviously flawed in its underlying construct, but still, like, he was penalized in the stock market as people lost faith in that vision. It led to active managers selling the stock and a damaging period during which everyone was convinced that Meta was going away.
Okay. And let's circle back to inelasticity, right? So the index didn't sell off, right? And so if Meta's got this deal going on, or Facebook's got this deal going on because Mark Zuckerberg's, being a bonehead or whatever, and active managers are like, yeah, this is a bad move. We don't want to own this stock. We don't want to be participating. But there's no one that showed up to work and was like, you know what I should do? Sell my target date retirement fund that owns Facebook in it. The indexes didn't rebalance. The indexes didn't say, oh, okay, this is a bad move. Let's get Facebook out of the index. just rides it out, right? And so the flows come back in, and the flows rebuy, and the flows push it back up. But the drawdown and the loss in the meantime was actually like pretty violent and significant for individual investors of Facebook, right? Or active managers. What kind of effect did the inelasticity potentially play into that? Because Facebook is thought of as a huge company. So if there's only a few active managers and they just dump a little bit of the stock, I mean, it shouldn't really matter that much, right?
Well, again, the size is less of an issue, right? Because again, remember the next dollar into passive will reflect the lower price and therefore allocate less. And so it becomes a little bit of a catch-22 that emerges, right? I, as an active manager selling, can drive the price lower. That then receives reinforcement by less buying from passive managers than they were having before. I'm convinced I've got this story right. Once all the active managers have exited or even gone further and shorted the stock, right, then it becomes very much like the scene from the movie Animal House where John Belushi says, all right, who's with me, right? And the answer is nobody, right? Nobody's with him. There's nobody to follow on from that. And so now you're suddenly trapped in a short position against a passive flow. All of a sudden, Facebook starts to look an awful lot like GameStop, right? And it violently rebounds in the opposite direction as those shorts are covering at the same time now that there is passive buying at an increasing pace. And so the whole thing was a giant kerfluffle of it doesn't actually matter, but we took it as an indication of something real happening within Facebook that really wasn't actually particularly relevant.
Well, I think like without the flows, it would have been really relevant, right?
Well, the flows were always going to occur. It's just a question of were they dominated by people who were discounting and doing a discounted cash flow analysis, or are they dominated by individuals who are, simply employed, right? And if they're simply employed, then the bias is upwards. It's only when you've got that stock of active managers who have bought in and said, "Oh, I think Facebook's the greatest thing on planet Earth," and all of a sudden they start changing the philosophy and identifying that there are risks to the business that didn't exist before. Suddenly those active managers reverse themselves, the price gets hit, this plays out, and then you find the active managers off sides in the other direction, all of which is just a reality that while we may think of price as a voting mechanism and we may ultimately believe in that weighing machine, if something like passive becomes a structural feature in which basically time is simply a proxy for passive flows into the system and passive share gain, the system just biases itself upwards. And you end up with a situation in which shorting a stock becomes shorting a highly convex position that can move very sharply against you for no real fundamental reason. Simply the absence of bad news becomes its own positive catalyst in that framework.
Man,
Sure feels like the market we've existed in, doesn't it?
you know what? It really, so what has changed that, why hasn't this always been the story, right? Why hasn't this always been the effect on markets? 401ks have been around not forever, but for a very long time, and even before that, you had people that save money in IRAs, back in the 90s, and you started having 401k plans pretty prevalent in the 90s. Is this what led to something like the .com, or is there something that's changed since that has changed the way structural flows have affected the market?
Well, it's interesting. So, my analysis of what actually transpired is that the .com cycle was largely a byproduct of what I call passive 1.0. And so I'll share another chart here just to orient your readers or listeners, as the case may be. So first of all, it's somewhat important to actually dimensionalize a couple of observations that you just made, which is the idea that 401ks have been around for a long time or IRAs have been around for a long time. I often try to emphasize to people that when we talk about financial markets, we actually have a very, very short time period in which to analyze these. There's roughly 5,000 years of recorded human history. There's give or take 100 years of decent financial market data, and there's roughly 11 years worth of really good financial market data in which we've got tick by tick analysis. That means it's really hard to examine what happened prior to about 15 years ago, and come to any really meaningful conclusions. What this chart does is this looks at correlation going all the way back into the 1920s. And to actually do a full correlation analysis is impossible. The way you have to do a full correlation analysis, you have to have, for the S&P 500, a 500 by 500 covariance matrix. You need to have the movements of each individual security, both the amplitude and their market capitalizations, if you're going to disaggregate it properly. There's a mathematical trick called Kendall's tau, or what's referred to as binomial correlation, that you can use to estimate this back much further in time. I could show a chart that shows how they largely overlap. There are periods of notable divergence, one of which we actually have just come through, but that's somewhat extraneous to the discussion. What binomial correlation does is simply asks if did two stocks move in the same direction on any given day. And if they do that repeatedly, then they're going to be correlated. And it turns out that the metric that emerges from that analysis is almost identical to the actual measure of correlation. So this is a unique data set that allows us to look at correlations back through time. Now, notice during the 1930s, when markets were down 95%, and there was a significant macroeconomic factor called the Great Depression, that stocks often behaved very much like each other. That began to disappear as the Great Depression continued and as things quote unquote normalized. But then importantly, the Investment Company Act of 1940 did something with mutual funds that most people fail to fully appreciate its magnitude. They stripped the ability to use undisclosed leverage from mutual funds. And what this meant was that you suddenly removed the inclusion of debt in portfolios or leverage in portfolios, which creates coordinated periods of selling activity. If you've ever invested in crypto, you're familiar with the dynamics of, liquidation waves that occur as prices fall and trigger liquidation of levered positions. That used to happen. It went away from basically 1940 until give or take 1994. And in 1994, something was happening that, again, almost nobody paid any attention to. Index funds were growing from about 1% of the market to about 2% of the market. And index providers like Vanguard began to struggle with what they called tracking error, which is their funds would diverge slightly because they would go in and try and buy all the stocks in the S&P 500. They would cause individual positions to move that would lead to their portfolio having tracking error. They went to the street and they said, hey, what can we do about this? And the street, the Wall Street bank said, well, wait a second. Why are you trying to buy every single security? Why not just buy futures? And they said, well, we can't because futures require a margin account. And margin accounts by definition are leverage. And therefore we can't under the Investment Company Act of 1940. And the Wall Street bank said, well, that's silly. Why don't you just lobby the SEC to get an exemption? They did. They said, look, we're not trying to speculate. We're just trying to enter the market as efficiently as possible so that we minimize the cost to our investors. And the SEC looked at this and said, well, this is good. They provided them with what's called a no action letter, which said, we know what you're doing is against the law under the regulatory framework, but we're going to ignore that for you because what you're doing is not nefarious in nature. And that actually, crazily enough, in my analysis, is what caused the dot-com cycle. And the reason it did was because the indices at the time were market cap weighted. Now, most people think they're still market cap weighted. They're not. They're float adjusted weighted, which means that companies that have very low floats, high proportions of insider ownership, will receive less representation in the index. That didn't exist in the 1990s, which meant that when the passive funds outsourced it to indexes in the form of futures, the futures brokers had to rush out and replicate the index by buying shares in proportion to their market capitalization. That perversely meant they were buying twice as many shares of a company like Microsoft as actually existed publicly traded. If you try to buy twice as much of something, you're going to cause its price to rise more rapidly. We didn't used to have factor funds, which would have facilitated the identification of this dynamic. Instead, we had sector funds. And so you'd have a technology fund or an industrials fund or a utilities fund. Well, if you draw the Venn diagram of low float, right, high proportions of insider ownership, it almost perfectly aligns with recent IPOs. And so the technology space, which were newer companies, were the most overweighted to this factor of outperformance called low float. And the sector began to outperform because the selection that was available to people was to buy technology funds. That meant money flowed into technology funds, bid up those companies, and the street, just as it did in 2005 and 2006 by manufacturing mortgages to fulfill the demand for mortgage investment options by European banks, et cetera, levered products in the United States in various forms. They manufactured product to meet this demand. They were called technology IPOs. And that's what the dot-com cycle really was passive investing 1.0. They changed the rules around how indexes are constructed in the United States and most other places around the world in 2003. And they, in my opinion, improperly represented that this was a very minor change. What they focused on was if they had simply reweighted the indices and ignored this insider ownership factor, that it wouldn't have resulted in significantly different performance in terms of the return of investing in the index, but that ignores the price impact that we were just describing. The way I figured this out was in that 2014 to 16 time period in which I was running my own hedge fund. We did this analysis on the Chinese stock market, which from December of 2014 until June of 2015 rose 500%. The reason why that happened was tied to this exact component. Unlike other indices around the world, the Chinese had not changed their indexes to be float weighted. They were still market cap weighted. And the unique feature in the Shanghai exchange was that many stocks had as little as 5% of their shares outstanding. And so as Western investors saw Chinese stock markets rise, and I actually had this exact conversation with our current Treasury Secretary, Scott Bessent, who is the primary investor in my hedge fund through Soros, what people thought was great things happening in China and a re-equitizing of China that would allow them to deal with their debt. What was actually happening was Western investors were trying to buy China through futures offered in Singapore. They couldn't invest directly in China because they lacked what was called QFII status, qualified foreign investment. I can't remember what the last one is, institution. That would have allowed them to buy directly. And so they were required to buy futures through places like Singapore. The index, the futures brokers were engaged in index arbitrage. That meant they went to China and tried to buy the representation of the index in terms of its market cap weighting. But because they were trying to buy 20 times as many shares as were outstanding for these 5% outstanding stocks, they actually caused them to go limit up every single day with no transactions. And so when we were monitoring this at my hedge fund Ice Farm, what we realized was at its peak, you were seeing roughly 15% of the Chinese stock market go limit up every single day. So 10% every single day without a single transaction actually happening. One company went up 32 consecutive days, 10% every day. So 1.1 to the 32nd power, right? With zero transactions happening. It was just limit up, limit up, limit up, limit up, limit up, which is reflected in the futures pricing, which is why we saw that index rise 500%. The minute investors tried to take their money out, the entire process reversed. Suddenly, we're selling 20 times as many shares as actually existed, and those stocks collapsed, bringing the index with it. If it hadn't been for that analysis, I doubt that I would have gotten as, convinced that I was correct in my analysis of this. And that also, along with that paper by Lasse Peterson, was a key contributor to understanding both what happened in the dot-com cycle and then what was happening as we exhausted that basically capacity expansion that was created by moving to float adjustment. Once we exhausted that and passive got to a large enough share that it influenced other securities in the same manner, effectively shrinking the effective float by virtue of hodling type behavior, as we've seen in Bitcoin or other cryptos, this manifested itself in spades in a much larger and more aggressive form post the COVID events.
Yeah, that's a lot of inelasticity in the Chinese market. When I was in college during COVID and we saw all this market crazy and mania going on, and I was in a program that was focused super heavily on valuation and, looking at future earnings, discounting, using a CAPM model, and having good, macro thesis on the whole thing, right? And I'm looking around, and everyone in class is like buying Dogecoin, and the price is just pumping, and you could almost get it from like sentiment, like, yeah, it's just going up, like everyone buy, and the more people were buying, and I remember just like scratching my head, going like, I had done a valuation on PayPal, and I was like, this seems like a great company, no debt, like decent fundamental story. There's some kind of moat here, and it's like doesn't go anywhere. And I'm just like, it should be higher, like, or this is like a really safe play, and then it experiences volatility, and like something's broken. And I'm not a smart, nowhere near as smart as you, or had any sophistication to this. I just thought of like the old quote. I think it was by, is it Wayne Gretzky? Right. I'm not a sports guy, but
it's skate to where the puck is.
Yeah. Skate to where the puck is, or skate to where the puck's going, right? Not to where the puck's been. So it's like, if everyone's going to buy S&P 5, this is in my head. This is what I thought about. And I remember thinking about this one day in like business law for some reason. If everyone's going to buy S&P 500 in the future, then I can buy S&P 500 today and know that somebody will want to buy it from me tomorrow. The odds of it being higher in the future are just good because there's all these people that have demand. And I saw more and more social media videos saying, you can just take all your wealth and put it in S&P 500 and it does this great return over time. And they talked about it as if it was like risk-free and can't fail. And it's just like S&P 500 should be used as the discounted like risk-free rate and everything. And I'm just like, well, let's get to where the puck's going. So just buy S&P 500, right? And I guess the story of flows says that's kind of the play, right? Why buy international? Why buy small cap? Why buy value? Why tilt any certain way? If on the margins, people are getting paid every 2 weeks, and the bulk of those assets when they hit the 401k plans are going into market cap weighted US stock.
Yeah, I mean, what you're highlighting is the classic components of what's called Ponzi finance, right? You basically are identifying that prices are going up because prices are going up, and therefore you should buy because prices are going up. That's an accurate description of a world that is passive dominated. As long as people have money flowing into markets, and the COVID dynamics created a tremendous amount of cash and compensation for people who suddenly were not, they're getting paid the same amount of money, but they're not driving to the office. They have time at home in which they are ostensibly just as productive operating over Zoom as they were in the office. But guess what? They actually suddenly have 2 hours free of commuting time per day that allows them to actually do more work if they want to, or spend time speculating in the stock market with cash that's been sent to them by the government, because they can't use it to go to the theater. They can't use it to go places. And so we effectively saw a dramatic increase in savings rates. And those savings were invested exactly as you described into stuff that was going up. Right now, unless you had the disadvantage of being educated in the way that you were, in which you thought about the fundamentals, you really had no reason to believe it was going up for anything other than, hey, it's going up, right? And people like money; they want to make money, right?
Mm-hmm.
And that is really what unfortunately transpired: is people chased into these investments, driving their prices higher and higher. And most of those have not recovered, but certainly many of the larger companies, whether they're influenced by index inclusion or whether they are influenced by dynamics like buying back stock, which also creates a competing flow, they've been pushed, back above even those levels in some situations by the simple reality that people retained their jobs, additional money came in. Fewer and fewer active managers were doing the discerning work or capable of opposing those types of price movements. Instead, things like the short, the short funds got blown up in that 2020 to 2021 time period. And nobody, worth their salt is thinking, gosh, what I really want to do is start a shorting firm at this point. Because why would I not take advantage of the dynamics that number go up? So, you've seen a narrowing and loss of intellectual rigor in the analysis of securities because it hasn't worked, right?
Yeah.
Again, you are aligned with those active managers who are getting fired. Why would you pick to be on a losing team?
Yeah. For me, the simple answer is I am a fan of active management and believe in active management because when this S&P 500 or indexation or passive bubble, it really, at the end of the day, when it comes unwound, it's going to be life-changing in a negative way for the people that are asleep at the wheel, is my opinion. Now, that might not be next week. It might not be next decade, but I think it's sort of it's going to have an end date eventually. When, I don't know. So the way that I chose to participate in this whole thing is largely like I'm a CMT, so technical analysis, and we try to be invested when the market is telling us it's a favorable time period to be invested. And we want to limit our exposure when it's not. But pretty much all of my clients would tell you my least favorite game in the world is picking stock, because picking stocks has seemed to just be exactly as you're saying, like you're just picking the losing side.
Yeah, I think that's right. And again, I think it's important to consider, though, that we're all in this game together, right? I used to use the example of the David Foster Wallace convocation speech of "This is water," right? Which, if you don't know the reference, David Foster Wallace in 2014 gave the example of we can't recognize the medium because we exist in it. And the story he told was two young fish are swimming along, pass by an older fish. The older fish says, "Hey, boys, how's the water?" And the two younger fish kind of look at him weird. They look at each other weird. They swim on a little bit further. One of them turns to the other and says, "What's water?" And, we exist in the medium of the stock market. We exist in the medium of the bond market. And so when these extraneous forces like government designation of passive investing as the qualified default investment alternative for 401ks biases the flows in the manner that we've described, we're forced to confront, are we crazy or is the water getting warmer? Right? And if you don't know what water is, if you've existed in it the entire time, you just note that suddenly you're actually forced to no longer mate because your reproductive system isn't working as fish do in much warmer water temperatures. And it can result in a catastrophic failure of the population, even though you don't actually notice it happening.
So the danger is not only a sudden crash, but also a potential to slow grind down.
Yeah, I mean, I think the sudden crash is more likely. It's likely to manifest itself as what begins as a slow grind, then turns into people suddenly saying, "Hey, wait a second, I've got some fantastic gains. I've got enough. Maybe I should take some money out," right? And when they try to take that money out, they're contributing to the forces that cause the prices to fall further, which then causes more people to say, "Should I take money out?" Right? So far we've been protected from that. The buy the dip has worked in part because money has been flowing into passive strategies. If that ever reverses, as I said, either widespread unemployment or a significant increase in unemployment, and as passive gets larger and larger, that fraction that is necessary gets smaller and smaller, or the simple reality that withdrawals from the market, how much you're willing to spend, are typically convex to the level of assets, right? If I become fantastically rich through my stock market spending, my stock market gains, I'm likely going to upgrade my lifestyle. And so I'll start to withdraw more money to afford that lifestyle. That paradoxically means that it becomes easier for outflows to exceed inflows, and the process, unfortunately, starts to work in reverse. When that happens is anybody's guess, but it gets easier and easier the higher the passive share and the higher and higher valuations rise.
Okay. Last question, I think, for you, or like last thing I want to talk about. Well, there's a million things I'd love to talk about with you, Mike, but I know you got to get going. So the way that I think about a lot of the markets at this point is just beta exposure, right? Like at this point, capital efficient and beta exposure sort of tells a story of risk and returns, volatility profiles. So I look at like S&P 500, and if you kind of know that flows are structurally supporting all of this, and S&P 500 and NASDAQ 100 as indexes have an overlap of 79 issues and extremely high correlation on a day-to-day basis. And the largest components of the S&P 500 that would receive most of the flows, or a disproportionate amount of the flows, are not only the largest components in the NASDAQ 100, but they have an even heavier weighting now because it's a more concentrated index.
Mm-hmm.
And so the question then becomes, like, is there even a difference at this point in the market, or a meaningful difference between owning S&P 500 or beta adjusted NASDAQ 100? That's to say NASDAQ 100 has a little bit higher beta than S&P 500. And so you own a little bit less maybe, but you should get the same amount of return from the flows coming into the market, basically. Is there a flaw in that thinking?
Well, the only flaw in the thinking is that the NASDAQ has larger companies by definition in it, right?
Mm-hmm.
It is more concentrated. It has many of the largest leading stocks. And so it is more influenced by that dynamic that I highlighted from Valentin Haddad's work, where size becomes a factor in the multiplier.
Mm-hmm.
You're actually perversely getting to a point where the NASDAQ is so concentrated that it's been forced to reduce the relative weights of some stocks in the index. That means it's getting closer and closer to the S&P, which is broadly the way it's playing out. So, should you buy the NASDAQ, or should you buy the should you buy the S&P 500? That's investment advice I'm not going to give. I would just highlight that in our current framework, the NASDAQ receives more benefit than does the S&P.
Yeah, I mean, I'm not trying to lean on you for advice there. It's just like, from a flows perspective, is there going to be
from a flows perspective, it's right. I mean, if you decide, well, I don't like those high flying technology stocks, I'm going to buy the S&P 500. Well, congratulations, you just bought the high flying technology stocks. You just didn't buy quite as much of them in a proportion to everything else, right? Now, if everybody were to switch from buying the QQQ to buying the SPY or the VOO, would you see a marginal relative gain for non-technology versus technology? Sure. Right. But it doesn't change the underlying calculus that you're still not actually doing any analysis of the underlying companies. You're presuming that other people have done that for you. And if those people are no longer the dominant voices in the market can move very rapidly away from any sort of fundamental valuation.
What about the Dow? Because the Dow is still price weighted in share. And so
there used to be an old joke, right? That newscasters would quote the Dow and market participants would quote the S&P. The reality is there's not much trading that actually happens in the Dow. There's a little bit because of the diamonds, but the reason in part why the Dow has underperformed is because it gets less sponsorship in proportion to its particular configuration, that price weighting component. Mm-hmm. There's nothing really wrong with price weighting. It's just, it was a tool that we used when we didn't have the information about shares outstanding on a regular basis or the capacity to do those calculations. Mm-hmm. And so it's an early attempt at indexing. It's flawed in its construction, just as all forms of indexing are flawed. They are approximations of what's going on, not an actual statement of what's going on.
But do you think the Dow could then be a proxy, or explain maybe where you would expect market returns to more look like if there wasn't this structural reinforcement of the momentum trade from passive flows?
I don't really think so, because the prices are influenced by the passive flows, and so those prices are changed by that. Now, will it have the same punch effectively because we're not buying things in exactly the proportion that they're represented in the Dow? Yes, it'll have less punch, right? You would expect it to underperform in a passive dominated world. So like, again, if we just run through these factors, right, the larger the company, the less elastic. That would be a slight positive for the Dow. It would be a significant positive for the NASDAQ. It'd be a meaningful positive for the S&P relative to smaller indices, but the S&P would be less exposed to those factors than, say, the Dow or the NASDAQ. The second component then is just the quantity of flows. And here's where the S&P really wins because their market cap weighting and the dominance of the S&P in terms of the narrative of what passive actually is means more flows are going in that direction. And so, if we X out the size component and the inelasticity component for the NASDAQ, my hunch, although I've not done this analysis, is that the S&P on a risk-adjusted basis is actually outperforming the NASDAQ. But again, that's a hypothesis I have not tested.
Yeah, it's hard to acknowledge any of the risk when it just seems like all dips are bought, and
Well, that's exactly the
it's
point, right? I mean, part of what I try to emphasize for people is that I'm telling you the cars and the brake don't work, and you're saying, yeah, but I'm going uphill. I can stop easily. Right. All I have to do is stop pressing the accelerator and I'll slow down. I just don't have to add money to the system. Right. The issue is once it starts going downhill, that's where it matters if you have brakes.
Yeah.
And we can't possibly know that until we start going downhill. And passive has continued to have positive inflows in basically any meaningful period that we look at for an extended period of time. There are a few notable exceptions to those days, to those, and they're measured in days, not months, really. In those days, we have seen the sort of catastrophic impacts that I talk about. We saw a component of that in, the March time period where the S&P fell at an accelerated rate. The NASDAQ fell even faster. Right? Why did this occur? Well, because suddenly it became questionable whether you could invest in the United States, and Western investors, not in the United States, European investors in particular, basically decided to reallocate capital. Canadian pension plans were forced to reallocate capital. That showed through as a significant capital account shift. Effectively, I was selling US dollar assets and buying European assets. It caused European stocks to dramatically outperform for a period of time. As things normalized, what have we seen? That process reverses, right? What was the line that was quoted on Bloomberg today? It's foreign investors rethinking their desire not to be exposed to the S&P 500. So they're coming back in. Right. Once you've sold, the only vote you have is do you re-enter? And when they choose to re-enter, it pushes prices higher, even though I think there are very few that would argue that the increase in tariffs is a net positive for the stock market. The stock market is now largely interpreting it as such.
It's a hell of a world out there, Mike.
It is a hell of a world, but you know what? We can make it a better place. And the most important things, I guess, that I would emphasize for people is one, the equities are uniquely exposed to this type of behavior because they are Ponzi assets in which the return, and I don't mean Ponzi in a criminal sense. I just want to be very clear on that. They're Ponzi assets in that the vast majority of your return is based on what the next player is willing to pay you for those assets. So there is no fundamental value at which they have to trade. It's simply a function of that next transaction. And to bring us full circle back to the first observation on the row houses, if somebody is forced to sell out of distress, we will interpret that as suddenly there's something wrong with those properties, and therefore we're less willing to buy unless we have a deep grounding in underlying fundamentals. You see that in the rapid shifts in sentiment. Prices fall, it's the end of the world. Prices rise, oh, it's all good, right? This is us staring at Plato's cave, right? We're watching a reflection of our actions rather than anything substantive and real. A couple of things I would highlight for people. This doesn't just affect equities, it also affects bonds. And so perversely, when the Federal Reserve hikes interest rates, what happens to long-dated, low-coupon bonds that were issued in the 2000 to 2021 time period, or the 2015 to 2021 time period, when we had extremely low interest rates? Well, those fall significantly in price because the bond indices, just like the equity indices, are weighted by price and market capitalization. That means that those assets now receive marginally less flow than they otherwise would have, basically 8/10 as compared to par for new issue paper. That means it's harder for long end to rally relative to the short end or to the belly of the curve. And that perversely manifests itself as the type of yield curve inversion that we've seen. So almost all economic indicators at this point that we use that are market derived are influenced by these factors. The good news is that bonds have what's called endogenous liquidity. And so credit in particular, I think this is true. At the end of the day, an equity depends on somebody else buying it from me. A bond depends on the company paying it back. right? I receive coupons and then the principal repayment at bond maturity. That principal repayment is not subject to the forces that we're talking about. It's a fixed dollar quantity. And so bonds, by virtue of having this endogenous liquidity characteristic, are less subject to these distortions. But perversely, it helps explain why we're seeing things like relatively low interest, relatively low inflation at 2+%. The most recent numbers are like 2.25%, which is basically right on target. And yet, long dated bonds can't catch a bid. Why? Because they are smaller within the index than they used to be. The exact opposite of what happened as interest rates were being cut in the 2015 to 2018 to 2021 time period. So, we interpret these as carrying fundamental information, and that information can become fundamental if policymakers are misled by this. But that's really what's happening. It's not that there's actual thought process that's going into it. For those who are worried that higher interest rates in the United States represent something akin to default because of our high levels of indebtedness, nothing could be further from the truth. US bonds have behaved exactly like Australian bonds, which only have a 25% debt to GDP, a very low historical level. So this is not a fundamental assessment of the credit quality of the United States. It's a market feature.
Man, talking bonds has got to be a whole nother episode, Mike. That is.
Well, that's what this week's Substack is about. So you can review that, and we can schedule another call at some point. And your mom will be just as confused in that one as she was in this one.
Yeah, probably. I'd like to think I probably have at least like 3 or 4 followers at this point, but we'll see. Anyways, well, I appreciate your time. Absolute wealth of knowledge. Yeah, thank you for coming on, and thank you for everything that you do.
Thank you very much, Brandon. I appreciate it. It's an honor to speak with you and your audience. And if they do want to follow our work, you can find us at simplify.us, www.simplify.us. Very easy to find me on Twitter. I'm ProfPlum99. The character Vicini is my avatar. And if you are interested in what I write in Substack, you can find that at www.yesigiveafig.com. And if you found all this totally boring and uninteresting, I totally understand. You don't have to follow me in any of those places.
I think it'd be interesting to have you come back on and we could do an episode about some credit hedge high yields. And I think a lot of my clients and audience would find that interesting.
Well, again, this is exactly the subject of this week's Substack, so hopefully you check it out. And Brandon, again, thank you very much for the interest.